Good day, FAC2602 students. Welcome to another lesson. I hope that the first assessment for semester 2 went well and that you were able to submit your answers successfully, both on the module side as well as the Invigilator app. Alright, so now that assessment 1 is over and done with, we can start focusing on preparing for assessment 2. In this lesson, I will be working through semester 1's assessment 2 for 2023. This assessment will not be a written assessment as was the case with assessment 1. Instead, it will be a quiz, and the first semester's assessment 2 contained 10 multiple choice questions that students had to answer on the module site under the assessment 2 tab. Based on the information that I have on this or at this point in time, assessment 2 will take place on the 12th of September at 6 p.m. Alright, and as I've said, you will need to complete the quiz on the main module site. Alright, but the lecturers will provide more information to you closer to the due date. Now that I've mentioned the due date of the 12th of September, please take note that the assessment will only be released on that date. It will not be available beforehand so that you can complete it in advance. Alright, it will only be available on the 12th of September at 6 p.m. and I believe the cutoff time will be 9 p.m. Alright, and the proctoring tool is likely to be Moodle proctoring. Alright, you have to be online for the full duration of the assessment, but again, the lecturers will confirm with you whether or not assessment 2 will be invigilated. Alright, the purpose of this lesson is not to go into detail regarding the administrative procedures for assessment 2. Instead, I would like to give you an overview of what the assessment will look like and what you can expect in this regard. Alright, so assessment 2 will be released in the form of a scenario. Alright, so the lecturers will provide a case study or a scenario to you for you to analyze. Okay, and then based on the scenario that they have provided to you, you will be required to answer the 10 multiple choice questions that the lecturers have asked in the assessment or have put in the assessment itself. Alright, I do not know if they are randomized questions, okay, meaning that no two students will receive the exact same questions. I do not have information at this point whether it will be so or not. Based on the first semester assessment 2, the same 10 questions were asked to all students. Okay, and you will notice that in the suggested solution as well. Okay, so as I've said, you will be provided with a scenario, and then you will be required to answer the 10 multiple choice questions based on the scenario that they have provided. Okay, so here you can take one of two approaches. Okay, the first approach will be to draft all the consolidated financial statements in full and draft every possible journal entry, okay, based on the information available in the scenario itself. Okay, however, I do not really recommend this approach because it is time consuming and not all the 10 questions will necessarily focus on, for example, the consolidated statement of financial position. Okay, the questions will contain a mix of journal entries. Alright, they can ask you for certain amounts that are disclosed in, for example, the consolidated statement of changes in equity. For example, what is the closing balance for NCI? Alright, based on the information provided. Another question can ask you for the correct journal entry to eliminate the unrealized profit in opening inventory. Okay, those are just examples of the type of questions that you can expect. Alright, for the purposes of this lesson, I have taken all 10 questions for assessment 2 of semester 1 and put them in a tabular format. Okay, please note that these questions are in no specific order. Alright, so meaning that they can be asked in any order. Alright, and I'm not saying that you can expect the same questions in this semester's assessment 2. Right, they are very likely to ask other types of questions as well. Okay, but you can expect the questions to be more or less like this. For example, property, plant and equipment in the consolidated statement of financial position amounts to. So now you have to calculate the amount that you will disclose as PPE in the group's statement of financial position. All right, and since assessment 2 covers learning units 1 to 7, all right, as you know, the elimination of intergroup transactions is addressed in learning unit 7. All right, so if there was an intergroup sale of a property, plant and equipment item either in the previous year or in the current year, we know that we need to take the unrealized profit or loss into account when calculating the carrying value of PPE for the group, as well as the depreciation associated with that specific transaction. Right, but we will get to that as we work through the case study. Okay, so let's get started without wasting any more time. So just general information that we need to take note of before we start with our calculations. The required section states that we need to answer the following multiple choice questions. Okay, that will be given, or those questions will be given on the module site, okay, on the 12th of September. So not in the document itself. The scenario will be provided separately. Okay, so please make sure that you first download the scenario before you start answering the questions. Okay, answer the following MCQs on the consolidated financial statements of the Green Limited Group as at the 28th of February 2022. Select only one option per question. Okay, that implies that only one option per question is correct. So you cannot have more than one option correct for a specific question. Okay, only one of the options given is correct. All right. From the required section, we can identify the identities of our parent and subsidiary respectively. Since we are dealing with the Green Limited Group, the parent is Green Limited and Rhine Limited will be the subsidiary. Okay, as I've mentioned numerous times, for the purposes of this module, we only deal with simple groups. Okay, that will be a group where there's a parent and one subsidiary. Okay, complex groups will be dealt with in FAC2602. Okay, the second piece of information that we can note from the required section is our current financial year. We are focusing on the financial statements for the year ended 28 February 2022. So the current year has started on the 1st of March 2021. All right, as I've emphasized numerous times in other lessons, please indicate your current financial year as well before you start with your calculations. Okay, so this is just general information that you need to take note of. And then the date of acquisition, which is given as part of the background information, is the 1st of October 2020. All right, clearly, if you compare the date of acquisition to the current financial year, we can clearly see that the group was formed in a previous year. Okay, so in other words, the group was not formed in the current year. So in other words, there was not an acquisition of an interest in a subsidiary during the year. Okay, the principles regarding this type of situation will be or is addressed in Learning Unit 6, which you should have studied as part of your preparation for this assessment. Okay, however, for this assessment, we will not be required to calculate a pre- and post-acquisition profit for the subsidiary. Why? Because the group was not formed in the current financial year. The group was formed in a previous year. All right, Green Limited obtained control over Rhine Limited on the 1st of October 2020. All right, so therefore, we will not be required to calculate a pre- and post-acquisition profit for the subsidiary, all right, that being Rhine Limited. So you can clearly see why it's important for you to quickly state your current financial year and then compare this to the date of acquisition. All right. Okay, so let's start with reading the background information. So Green Limited manufactures a wide variety of eco-friendly products, and on the 1st of October 2020, Green Limited expanded its operations and acquired an 85% stake in Rhine Limited. Okay, stake is just another term for interest. The financial year end of both companies is on 28 February 2022. This is confirmed in the required section as well. And the information below represents the trial balances of Green Limited and its subsidiary Rhine Limited as at the 28th of February 2022. Alright, so they give you the trial balances for the two companies, and then they give you additional information regarding intergroup transactions, regarding the equity balances at acquisition. So you will use the additional information as well as the trial balances for the two companies in order to answer the questions that are provided. Okay, so it is very important that you note the percentage interest of the parent in the subsidiary's ordinary equity. In this scenario, we do not have any preference share capital, because preference shares and preference dividends are only addressed in Learning Unit 9. Okay, so it falls outside the scope of the first assessment, or second assessment, excuse me. It falls outside the scope of the second assessment. So in this question, we only deal with ordinary share capital. Okay, we only have one analysis of owner's equity calculation, and the parent has an 85% interest in the subsidiary's equity. Okay, that percentage has been provided because there is not enough information in the trial balances for you to calculate the percentage interest that the parent has in the subsidiary's equity. Okay, so what I'm trying to say here is that if you go to your analysis of owner's equity, you do not have to calculate this percentage right here. It has been provided as 85%. And remember that the analysis of owner's equity is a very important calculation. Okay, and you will definitely use this as part of you answering the questions, or as part of answering the multiple choice questions. Right, so Green Limited is the parent. We have already established that, and then the percentage interest of the parent is 85%, which means that your non-controlling interests will take up the remaining 15%. The acquisition date is the 1st of October 2020. Alright, so before you even start drafting the analysis of owner's equity, you first need to take note of the questions that are asked. Alright, as I've said in the beginning of this lesson, you can draft every possible financial statement as well as the pro forma consolidation journal entries based on the information that you have at your disposal. However, it is very time consuming, so instead I recommend that you do your calculations per question. Okay, so for the first question, we are asked to calculate the amount of other income that will be disclosed in the consolidated statement of profit or loss and other comprehensive income for the year ended 28 February 2022. So now we need to take all the information into account that has an effect on other income. Alright, and you will find that information in your trial balances as well as under additional information, because there can be intergroup income that must be eliminated for consolidation purposes. For example, where the parent has received a dividend from the subsidiary. Okay, we know that that dividend will normally be included in the parent's other income, and since it is an intergroup item, it must be eliminated for consolidation purposes. Okay, remember when we talk about consolidated other income, we are referring to the other income amount for the group. Okay, so in the consolidated statement of profit or loss and other comprehensive income, what is the amount that you will disclose as other income? Okay, great, so let's get started. Just before we get to question 1, I would just like to mention that the suggested solution that I've prepared for assessment 2 is available under files on the FAC2602 Telegram group. Okay, you will find it under files on that group as well if you want to compare the figures that I've presented in this lesson to that document. And if you come across any discrepancies, please send me a message so that I can help clear up any misunderstanding, or to help clear up those discrepancies. Alright, so the first question asks the consolidated other income amounts to what? So they will give you various options, okay, and you will have to choose the correct amount for other income. Okay, so how will we calculate other income for the group? Okay, firstly, we will need to look for the other income line item in the trial balances. Okay, and you will find it right here under credits. Other income has been given for the two companies respectively. Okay, so you will start by adding those two amounts up, because remember, during consolidation the subsidiaries items will form part of the group. Okay, in the post-acquisition period or after the group was formed, the subsidiaries items will be included as part of the group. Right, so we will start with the amount for the parent, which is 106,800, and then we will add the amount of other income for the subsidiary, which is 54,200. Okay, but before concluding on this calculation, we need to take into account the other information, or the additional information that has been provided in the case study. Okay, we need to look for any intergroup dividend, as well as other intergroup income items that might have been earned within the group. Okay, if you go to your debit section, you should notice that dividends were paid by both companies. Okay, and because the parent, Green Limited, is in effect a shareholder of the subsidiary, okay, you need to keep in mind that the parent would have received a portion of the dividends paid by the subsidiary, okay, based on its percentage interest that we have inserted in the analysis of owner's equity calculation. Okay, so for dividends paid by the subsidiary, which is 65,000, we need to calculate the portion that was paid to the parent. Okay, and in the absence of any further information or information that states otherwise, you may assume that dividend received is recorded in other income. Okay, so the only income items that we have are sales, other income, and interest income. Alright, so dividend income is assumed to be part of other income. Alright, so in other words, the 106,800, okay, recorded in the parent's records includes the dividend received from Ryan Limited, the subsidiary. And this portion must be eliminated because it is an intergroup item. Okay, the group cannot pay dividends to itself. Alright, it's very important that you take note of that. So in calculating other income for the group, we need to subtract the intergroup dividend, which we will calculate by taking the percentage interest of the parent, which is 85%, and we multiply this by the dividend paid, or the dividends paid by the subsidiary, because the remaining 15% would have been paid to your non-controlling interests. Alright, so we started with 106,800, we added the amount for the subsidiary, and remember, this amount right here includes the intergroup dividend, which we will calculate by taking 85% and multiply it by 65,000. 65,000 Rand is the amount of dividends paid by the subsidiary. Remember also that the dividends paid by the parent, 45,100, will be disclosed in full in the consolidated statement of changes in equity in the retained earnings column. Right, those dividends paid do not include any intergroup portion. Okay, it is only the subsidiaries dividends that were paid that includes an intergroup portion, because 85% was paid to the parent and the remaining 15% was paid to external investors, or your non-controlling interests. Alright, and we need to eliminate the intergroup portion for consolidation purposes. Alright, so this amount right here represents the intergroup dividend. Alright, intergroup dividend. Okay, just making sure that it is still recording. Okay, And then we just need to look at additional information point 2, which says that Ryan Limited pays Green Limited a monthly management fee of 4,500 Rand. This is for the provision of consulting services, and the agreement dates back a few years. Okay, very important that you notice that Ryan Limited is the one that pays the management fees and Green Limited receives the management fees. Again, any absence of information that states otherwise, you may assume that the intergroup management fees that were received from Ryan Limited was recorded in other income in Green Limited's records. Okay, because those are the only income items that we have for Green Limited. So, in conclusion, we can say that the 106,800 also includes the management fees that were paid by Ryan Limited. Alright. Likewise, Ryan Limited would have recorded the management fees paid as part of other expenses. Okay, so to eliminate the intergroup management fees, okay, and it's very important that you take note of the fact that the agreement dates back a few years, which means that the intergroup or the monthly management fee of 4,500 was paid for the full year. Okay, so in other words, for 12 months. Okay, it's very important that you take note of that as well, because if the agreement was entered into within the current year, you will only include those monthly management fees that were paid after the agreement has been entered into. Alright, please take note of that. But in this case, to calculate the total management fees for the year, you will just take the monthly amount of 4,500 Rand and multiply this by 12. Okay, because the management fees were paid for the full year, and we know that this amount for the year has been recorded in other income for Green Limited. Okay, so to eliminate the intergroup management fees, I have also included this journal entry in the suggested solution. Please note you are not required to draft this journal entry. Okay, it just helps you to understand the elimination. Okay, so you will debit other income for Green Limited, because other income normally has a credit total or a credit balance. So to eliminate, we will just debit other income. Intergroup management fees will be calculated by taking 4,500, multiply this by 12. Okay, this will then give you 54,000, and you would just then credit other expenses for Ryan Limited. 54,000. This represents the elimination of intergroup management fees for the year ended 28 February 2022. Okay, so based on this journal entry, we need to subtract 54,000 Rand when calculating consolidated other income. Okay, remember all of these adjustments are based on the pro forma consolidation journal entries. Okay, but we have already addressed the intergroup dividend that was received from Ryan Limited, and now we just need to subtract the amount of management fees that were received from Ryan Limited. Because it is an intergroup item, it must be eliminated for consolidation purposes. Right, let me just make this black. There you go. This represents intergroup management fees. I will now correct that. Let me just check something. Alright, good. So other income that will be disclosed in the consolidated statement of profit or loss and other comprehensive income is 106,800 plus 54,200 minus the intergroup dividend, and then subtracting the intergroup management fees. So other income for the group amounts to 51,750 Rand. Okay, so you should have chosen the relevant option for this question. The option that reflects this amount right here. Okay, 51,750 is the correct amount for other income for the group. After we have eliminated intergroup income items, so that being the intergroup dividend as well as the intergroup management fees. Alright, let's move on to question 2, which says that we have to calculate the consolidated sales. So in other words, sales or revenue for the group will be calculated as follows. As previously, we will start with the amounts given in the trial balances. So you will start with 3.55 million, which is the amount of sales for the parent for the current year. We will then add the sales amount for the subsidiary, which is 3,215,000. And then we need to look for intergroup sales that took place during the current year. And you will find the information in additional information point 3. Please excuse me for a minute, I'll be right back. Good, let's proceed with the calculation of consolidated sales. So intergroup inventory sales that took place during the year is given in additional information point 3. The intergroup sales for the current year amounted to 750,000. Alright, and we need to eliminate intergroup sales for the year, or for the current year, as follows. Again, you are not required to draft this journal entry, it's just for you to better understand the elimination thereof. So to eliminate intergroup sales that took place during the current year, we will debit sales, alright, for the company that sold the inventory intergroup, and in this case it was Rhine Limited. Okay, according to additional information point 3, Green Limited purchases all of its inventory from Rhine Limited. So Rhine Limited is the company making the sales. So to eliminate intergroup sales, we will debit sales for Rhine Limited. The amount that's been given as 750,000, and at the same time we will credit or we will decrease cost of sales for the company that purchased the inventory. So credit cost of sales for Green Limited. Right, 750,000. This is the elimination of intergroup sales for the current year. Right. So that is the journal entry that you will draft to eliminate intergroup sales for the current year. As you can see, since we are debiting sales for the subsidiary, this will be shown as a negative adjustment in our calculation. So therefore we will subtract 750,000, which represents intergroup sales for the current year. So your consolidated sales will amount to the following: 3.55 plus 3.215 million, and then we just subtract intergroup sales for the current year. So consolidated sales amount to 6,015,000. Right, that is the amount that will be disclosed as sales in the consolidated statement of profit or loss and other comprehensive income, or the amount for revenue that you will disclose in that particular financial statement. Alright, so we are done with consolidated other income. Alright, just for completeness, let us just quickly draft the journal entry to eliminate the intergroup ordinary dividend and to record the NCI share in that dividend as well. Okay, we already established that the intergroup dividend has been included in the parent other income. So therefore you will debit other income for Green Limited. The intergroup dividend is calculated by taking 85%, which is the percentage interest of the parent in the subsidiary's ordinary equity, and we multiply this by 65,000 because this is the amount of dividends paid by the subsidiary. So total dividends that were received intra-group amounts to 55,250. We will then debit non-controlling interests, or NCI, okay, as disclosed in the statement of financial position or in the consolidated statement of financial position. As I've also indicated, the NCI will just take up the remaining 15% of interest, and then you will credit the dividends paid line item, which is shown as a debit balance in the trial balance for Ryan Limited. So you will then credit dividends paid for Ryan Limited by 65,000, or with 65,000. So this is the elimination of intra-group ordinary dividend and recording the NCI share in that dividend. Okay, why do we record the NCI share as well? Apart from the fact that it forms part of the elimination, we need to show the dividends paid to NCI in the consolidated statement of changes in equity. So it will affect the closing balance of NCI for the current year. So, and recording the NCI share in dividend. Okay, this is just for you to have a better understanding of the elimination. Since we are debiting other income, this was shown as a negative adjustment in our calculation of other income for the group. And we have already addressed the management fees as well. Okay, so let us move on to question 3, which asks, or which states that the opening balance, okay, it's very important to take note that it is the opening balance for non-controlling interests, or NCI, where X is the unrealized profit included in opening inventory, is calculated as follows. Alright, now in order for us to calculate the opening balance for NCI, so the balance for NCI as at the 1st of March 2021, because the 1st of March 2021 is the beginning of the current financial year. So in order for us to calculate that balance correctly, we first need to complete our analysis of owner's equity. Okay, specifically, we need to complete the at acquisition section, as well as the since acquisition to the beginning of the current year. Right, it's not necessary at this stage to focus on the current year section. We only need to focus on the first 2 sections that I've mentioned. Okay, at acquisition and since acquisition to the beginning of the current year. So let's go to our analysis of owner's equity calculation at the 1st of October 2020, and then we just need to determine the equity balances for Ryan Limited as at the 1st of October 2020, and that will be given in additional information point 1. On the date of acquisition, the 1st of October 2020, the retained earnings of Ryan Limited amounted to 1,305,000. Okay, so we will enter that amount as such. Retained earnings 1,305, which is then split between the parent and NCI according to their percentage interest or respective interest in the subsidiary's equity. Right. So we have the retained earnings balance. The carrying amounts of the assets and liabilities of Ryan Limited were deemed equal to the fair values at acquisition, and Ryan Limited has not revalued its assets again since the date of acquisition. So meaning that there was no revaluation for the subsidiary after the date of acquisition. Okay, and it's very important that you take note of this, because if you look at your trial balance for the subsidiary, we have a revaluation surplus balance of 180,000. Okay, but this is the balance as at the 28th of February 2022. So now you might be asking, okay, so if we have RVS of 180 at year end, what was the balance at acquisition? Okay, have they provided us with enough information to calculate that balance? Okay, and according to additional information point 1, the subsidiary has not revalued its assets since the date of acquisition. This means that the RVS balance at year end, which is 180,000, is the same as the balance at acquisition. Okay, there has not been a change in the RVS balance since the date of acquisition. Okay, so in other words, the conclusion that we can make here is that the balance of revaluation surplus for the subsidiary at acquisition was 180,000. Okay, based on the information provided in additional information point 1. The fact that the subsidiary did not revalue its assets after acquisition. So in other words, there was no change in revaluation surplus for the subsidiary since acquisition. Okay, so we only have an at acquisition amount of 180,000. Again, this amount was provided as part of the extract of the trial balances for the two companies respectively. Okay, revaluation surplus 180,000. There was no change since acquisition, so that was also the balance at acquisition. Okay, that being the 1st of October 2020. So we have the retained earnings balance, and we have now determined the RVS balance. Now we just need to look at share capital. Now the issued share capital of both companies remained unchanged since acquisition. Again, this is the same as with the revaluation surplus balance. The balance at year end for share capital, okay, which is 1,550,000, was also the balance at acquisition. And for the purposes of this module, we will assume that there has not been any change in share capital for the subsidiary since acquisition, because changes in ownership will only be addressed in FAC2764, okay, where there has actually been a change in share capital after acquisition. All right, that will be addressed in FAC2764. For the purposes of FAC2602, we will assume that the share capital balance for the subsidiary at year end, okay, which is given in the trial balance, was also the balance at acquisition. So the balance at acquisition for share capital is 1,550,000. Okay, again split between the parent and non-controlling interests. And I want you to focus on the NCI column, because remember that the question has asked us to calculate the opening balance for NCI, and then they have indicated a variable for the unrealized profit in opening inventory. Okay, we'll get to that. All right, and then we just need to enter the amount of consideration that was received from the parent for its investment or its share in the subsidiary's equity. You will find that in the debit section, investment in Ryan Limited, or the investment in subsidiary line item. So the parent has paid a total consideration of 2.8 million rand for its investment in the subsidiary. Clearly, as you should notice, we have an acquisition at a premium. This is confirmed by the fact that the consideration received or paid by the parent exceeds the net asset value that is attributable to the parent. In other words, or in simpler terms, the parent paid more for its investment in the subsidiary than it should have paid, because this is the actual share in equity at acquisition, and this is the amount actually paid. So the difference between these two, or the excess amount, is goodwill. Okay, and I believe there is a question later on that asks you to calculate the amount of goodwill, right? Which is again important that you draft this section correctly. Okay. All right, so we have an NCI balance at acquisition of 455,250. Okay, and then we just need to complete our since acquisition to the beginning of the current year. So we need to calculate the change in retained earnings, which we will do as follows. We will take the balance at the beginning of the current year, which was the 1st of March 2021, and according to your trial balance, retained earnings beginning of the year or beginning of year for the subsidiary is 1,520,000. So that amount will be entered right here, and then your balance at acquisition, which was the 1st of October 2020, was given as 1,305,000. Ooh, let me just correct that. All right. That is the change, or there is the change in retained earnings. Again, this must be split between the parent and non-controlling interests. All right. But we are not done yet. Okay, we still need to take into account the unrealized profit in opening inventory. Now, a very important point that I'd like to mention. If the subsidiary, okay, made the unrealized profit, okay, through the intergroup sale of inventory, okay, so the subsidiary has sold that inventory, okay, the elimination of the unrealized profit itself will then be shown in the analysis of owner's equity as well, okay, because the subsidiaries accounts are affected, and you will see that as I draft the journal entry. Okay, it's very important that you notice or that you determine the party or the company that sold the inventory intergroup, because if the parent has sold the inventory, okay, it means that the parent has made the unrealized profit on that sale, okay, so therefore the adjustment or the elimination of that unrealized profit will not be shown in the analysis of owner's equity because the subsidiary has not made that profit. Okay, but in this case, the subsidiary has made the unrealized profit on the intergroup sales of inventory. Okay, given in additional information point 3. Okay, again, it says that Green Limited purchases all of its inventory from Ryan Limited at cost plus 30%. We will use the 30% to calculate the unrealized profit. All right. And on the 1st of March 2021, so at the beginning of the current year, the inventory on hand in Green Limited amounted to 320,000, and the inventory on hand in Ryan Limited amounted to 470,000. Okay, so which amount do we use to calculate the unrealized profit? Again, it's important to determine which company sold the inventory, okay, or purchased the inventory. So Green Limited has purchased the inventory, actually all of it. All right, so therefore the inventory in Green Limited's records will include the unrealized profit, okay, and not the inventory of Ryan Limited, because Ryan Limited has not purchased the inventory. Ryan Limited has actually sold the inventory. So the inventory for Ryan Limited is irrelevant in our calculation because this amount of 470,000 does not include any unrealized profit. Okay, it's only the inventory of Green Limited that includes the unrealized profit. How do we determine this? Because Green Limited has purchased the inventory intergroup. All right, so its opening inventory will include unrealized profit that we must eliminate for consolidation purposes. Okay, but in question 3, they have not asked you to calculate the amount of unrealized profit in opening inventory. Okay, but I will do that just so that you can better understand the elimination process. Okay, so X can be calculated as follows. Okay, in opening inventory, so we will take the inventory for Green Limited, which we have determined to include unrealized profit. That was 320,000. Okay, the opening inventory for that company, 320,000. To calculate the unrealized profit, we will multiply this by 30, right, over 130. Okay, 30 is, or 30% is the markup, and because this amount already includes the unrealized profit of 30%, we will use 130 as part of this calculation. Okay, not 100. All right, because this is actually the sales value for Ryan Limited. Okay, and it will be the cost for Green Limited. So this already includes the unrealized profit of 30%. Okay, and according to additional information point 3, Green Limited purchases all of its inventory from the subsidiary. So in other words, 100% of this amount includes unrealized profit, because there can be a scenario where or a situation where the parent only purchases some of its inventory from the subsidiary. In this case, all of the inventory is purchased intergroup, so the entire amount of 320,000 includes unrealized profit. Okay, and that amount will be calculated as follows: 320,000 times 30 over 130 times 100%. So the unrealized profit that is included in opening inventory of Green Limited is 73,846. Okay, this is the amount of X. Right. Now, how do we eliminate the unrealized profit in opening inventory? Okay. Now, very important, when it comes to the unrealized profit in opening inventory, we need to assume that that profit has actually been realized in the current year. Alright? So in other words, for the current year, we need to increase the profit of the company that sold the inventory intergroup. So in other words, what I'm trying to say here is that since this profit has been realized through sales during the current year, okay, we need to increase the profit for Ryan Limited, because Ryan Limited is actually the company that sold the inventory intergroup, and we will increase their profit by decreasing their cost of sales for the current year. And this adjustment will then be made against retained earnings, also for Ryan Limited. So the journal entry to eliminate the unrealized profit in opening inventory, we assume that the profit has been realized in the current year. So therefore, we will credit cost of sales, because again, as I've said, we need to increase the profit for Ryan Limited, okay, the company that sold the inventory intergroup. And we will do that by debiting, or not debiting, we will do that by decreasing their cost of sales account. How do we decrease cost of sales? We will credit cost of sales. So in other words, we will credit cost of sales for Ryan Limited, which is 73,846, and we will debit retained earnings for the same company, Ryan Limited, 73,846. Please also note that a detailed explanation of the elimination of unrealized profit in opening and closing inventory is given in Learning Unit 7. Okay, explanations for both eliminations are given in Learning Unit 7. So please go have a look at the explanatory notes that the lecturers have provided if you are confused by my explanation. Okay, just a quick recap again. We are eliminating the unrealized profit in opening inventory because it forms part of our calculation of the NCI balance. Why? Because the subsidiaries accounts are affected. Okay, that is why. And that is also why we draft this journal entry, to see what adjustments need to be made in this regard. Okay, so we are debiting retained earnings for the subsidiary. So this adjustment, or this component of the journal entry, will be shown in the analysis of owner's equity. Okay, in the since acquisition to the beginning of the current year section. So in your analysis of owner's equity calculation, since acquisition to the beginning of the current year, because the subsidiaries account is affected, or the subsidiaries retained earnings is affected, we need to show this adjustment in this section. So this will be unrealized profit included in opening inventory of Green Limited, or G Limited for short. And because we are debiting retained earnings through this journal entry, we will show this as a negative adjustment, 73,846. Okay, similarly, the second component, that being crediting cost of sales, will not only be shown in the consolidated statement of profit or loss and other comprehensive income, all right, it will also be shown in the analysis of owner's equity, because it involves an unrealized profit. So that adjustment will also be shown in the current year section. Okay, but again, we are busy with question 3 that only asks us to calculate the opening balance for NCI, where the unrealized profit in opening inventory has been replaced by X. Okay, so this was a negative adjustment against retained earnings according to our journal entry, and then the change in retained earnings will be split between Green Limited, and NCI. Alright, so in conclusion, the opening balance for NCI will be calculated as follows. Opening balance for NCI, remember that the options given for this specific question will make use of X as the unrealized profit in opening inventory. So in other words, it will replace the actual value of 73,846. Okay, so the opening balance for NCI, so that being as at the 1st of March 2021, was calculated as follows. We took the percentage interest of NCI, which was 15%, and then we just need to calculate NCI's share in equity. Okay, according to our analysis of owner's equity. So we know that these amounts have been calculated as follows. So it will be 15% times, let me just make sure that I've calculated this correctly. So you will start with retained earnings. Okay, let me just combine, let me split this so that you can understand the calculation easy. Alright, so we'll take 15% and we will first calculate the at acquisition balance of 455,250, which is just 15% of this amount right here. Okay, the sum of these three will give you 3,035,000, and 15% of this amount is attributable to NCI. So therefore 15% of 1,550,000, which was share capital. Then we have retained earnings of 1,305, and we have revaluation surplus of 180,000. Okay, this portion right here, or this particular calculation, is the at acquisition balance. Okay, but we need to take the change in, or we need to take since acquisition to the beginning of the current year into consideration as well. Okay, so we will take at acquisition balance plus since acquisition to the beginning of the current year for NCI. So plus 15% times this amount right here. 15% of 141,154, okay, is attributable to NCI, which was calculated as follows. We took the opening balance for retained earnings, which was 1,520,000. We subtracted the balance of retained earnings at acquisition because we are calculating the change in retained earnings, okay, since acquisition. And then we subtract 73,846, okay, due to the unrealized profit in opening inventory of Green Limited. However, as I've said, this amount has been replaced by X, so therefore we will replace this by X. So minus X. Okay, and then we just need to combine these two. Alright, so you will have in effect 15% times 1,550,000 plus 1,305 plus 180 plus 1,520 minus 1,305 minus X. Okay, as you will see, these two will in effect cancel each other out. So in other words, to calculate the opening balance for NCI, you will take 1,550,000 plus 180 plus 1,520 minus the unrealized profit in opening inventory, which has been calculated as 73,846. Alright, so just for confirmation, right, let us test whether our amounts add up correctly. So if we calculate the correct balance for NCI as at the 1st of March 2021, you should get the following amount: 15% times 1,550,000 plus 180 plus 1,520,000, and then we subtract the unrealized profit in opening inventory, which is 73,846, So your NCI balance at the beginning of the year should be 476,423 if you use this formula right here. Okay, and this will be one of the options given for question 3. Okay, that you need to choose as part of answering the question. Okay, if we compare this to our analysis of owner's equity calculation, the at acquisition balance was 455,250, and then we just need to add the NCI share since acquisition to the beginning of the current year, which was 21,173. Again, there has not been any change in revaluation surplus since acquisition. So the sum of these two should give you the NCI balance at the beginning of this year, which is indeed 476,423. Okay, in other words, our formula for calculating the opening balance for NCI is correct. Right. So just make sure that you are able to confirm the correctness of your calculation by comparing the formula that you arrived at to your analysis of owner's equity figures. Alright, I know that has been a mouthful, so take a quick breather before we continue with question 4. Okay, so we are done with the opening balance for NCI, and at the same time, and you will see later on that they have asked you to indicate the correct journal entry to eliminate the unrealized profit in opening inventory. So now that you have done that, you can answer that question as well. Alright. Okay, but for the NCI opening balance, we calculated the at acquisition balance, okay, based on this highlighted section. So 15% of the equity balances at acquisition, and then we calculated the NCI share in retained earnings since acquisition to the beginning of the current year by calculating the change in retained earnings and considering the unrealized profit. Alright, because according to our journal entry that I've explained in detail, the subsidiaries accounts or the subsidiaries retained earnings was affected because the subsidiary made the unrealized profit that was included in opening inventory. Ryan Limited sold the inventory into group, and then we just calculated the NCI balance at the beginning of this year by using the formula, and we confirmed that this is correct based on our analysis of owner's equity calculation right here. Okay, 476,423 is the correct opening balance for NCI. Again, they have not asked you to calculate the actual balance or the amount of the opening balance. They rather asked you for a formula to calculate the opening balance for NCI based on or where X is the unrealized profit in opening inventory. Then you will use this one to calculate that value. Right, and this has been confirmed to be correct. Alright, let's move on to question 4. Now, question 4 asks you to calculate the property, plant and equipment balance that will be disclosed in the consolidated statement of financial position. Alright. Property, plant and equipment, according to our additional information, there has not been any intergroup sale of a property, plant and equipment item. So we can only focus on the trial balance figures, or the figures given in the trial balances respectively for the two companies. So you will start with your cost values. So firstly, we need to look at land and buildings as well as plant and machinery. Okay, so let's start with land and buildings. 2.3 million for the parent, plus land and buildings for the subsidiary, which is 1.6 million. Then we go over to plant and machinery, which is 1,715,000, and then we just add plant and machinery for the subsidiary, 2,520,000. Okay, very important that you notice in the credit section they have given you the balance for accumulated depreciation for plant and machinery for the two companies respectively. As we know, according to IAS 16, we need to disclose property, plant and equipment at carrying amount in the statement of financial position. So in other words, we need to subtract accumulated depreciation from these amounts right here in order to calculate the amount that will be disclosed in the consolidated statement of financial position. Again, there has not been any intergroup sale of PPE items that we need to take into account. So we will subtract 162,100, which is the accumulated depreciation amount for the parent, and then we also need to subtract the accumulated depreciation for the subsidiary, which is 115,000. Right, so this is a really straightforward calculation. We add up all the PPE values, so that being land and buildings as well as plant and machinery, and then we just need to subtract accumulated depreciation, because PPE will be disclosed at carrying amount in the statement of financial position. Alright, based on this calculation, you should arrive at an amount of R7,857,900. This is the value of property, plant and equipment that you will disclose in the consolidated statement of financial position. Okay, so in other words, that will be the amount disclosed right here. Okay, property, plant and equipment, non-current assets, 7,857,900. Once again, there was not any intergroup sale that we needed to consider. But examples of such transactions are addressed in Learning Unit 7. So please revise Learning Unit 7 if you are unsure how to treat intergroup sales of PPE items. Alright, very straightforward calculation. Let's go to question 5. So question 5 says that the consolidated inventory, alright, so inventory that will be disclosed in the consolidated statement of financial position. Okay, so what amount will you disclose as inventory right here, right? Where A is the unrealized profit in opening inventory. Okay, keep in mind we have already calculated the correct amount of unrealized profit in opening inventory, and we have drafted the journal entry. So just keep that in mind. And B is the unrealized profit in closing inventory. Amounts to what? Okay, so in other words, how will you calculate the inventory balance that should be disclosed in the consolidated statement of financial position? Now, let us go back to our journal entry where we eliminated the unrealized profit in opening inventory. Okay, we said that we will debit retained earnings and we will credit cost of sales for Ryan Limited. Okay, 73,846. So clearly, based on this journal entry, the inventory balance is not affected. Okay, the elimination of unrealized profit in opening inventory has no effect on the inventory balance that should be disclosed in the consolidated statement of financial position. Alright, can you see why it's important for you to draft these journal entries correctly? Okay, however, the elimination of the unrealized profit in closing inventory will have an effect on the inventory balance. Okay, now according to additional information point 3, I would just like you to refer back to that point again. Green Limited has purchased all of its inventory from Ryan Limited at cost plus 30%. Alright, now if you look at your inventory balance, okay, we have already determined as well that Green Limited's inventory is the inventory balance that includes unrealized profit. So in other words, the 270,000 includes the unrealized profit of 30%. The 260,000 for the subsidiary does not include unrealized profit because the subsidiary is the one that makes the intergroup sales of inventory. Okay, so in other words, Green Limited has purchased the inventory, so Green Limited's inventory will include the unrealized profit. Okay, why do we refer to it as unrealized profit? It is because it's because the profit has not been realized outside the group as yet. Okay, the profit was made intra-group and has not been realized outside the group. And because of this, we need to eliminate it for consolidation purposes. So the closing inventory balance for Green Limited is 270,000. And according to additional information point 3, 100% of this amount includes the unrealized profit of 30% that must be eliminated for consolidation purposes. How do we arrive at the 100%? Green Limited purchases all of its inventory from the subsidiary, so the entire amount includes unrealized profit. Okay, so in conclusion, we will calculate the inventory balance, okay, at year end for the group as follows. We will start with the amount for the parent, which is 270,000. Okay, let me just draft the journal entry first, okay, to eliminate the unrealized profit in closing inventory. Now, because the profit has not been realized outside the group as yet, all right, we need to decrease the actual profit made by the company that sold the inventory. So in this case, it will be Ryan Limited. So we need to decrease the actual profit made in the current year by Ryan Limited. And we will decrease their profit by increasing their cost of sales account. So in other words, we will debit cost of sales for Ryan Limited. The amount of the unrealized profit is calculated as follows. We will take the inventory balance for Green Limited of 270,000. We will multiply this by 30 over 130 because the markup on cost is 30%. So the unrealized profit represents 30%. And we use 130 because this amount already includes the unrealized profit of 30%. Right, keep that in mind. All right, and then as I've said, 100% of this value includes unrealized profit that must be eliminated. So the total unrealized profit in closing inventory is 62,308. Right, and since we are increasing cost of sales, okay, this will decrease the profit made for the current year, as I've already explained. But also bear in mind that this unrealized profit of 62,308 is included in the inventory balance for Green Limited. So in other words, we need to decrease the inventory balance for Green Limited. So therefore, we will credit inventory for Green Limited by the same amounts, 62,308, and this is the elimination of unrealized profit in closing inventory. The reason why I've drafted this journal entry first is to see what adjustment we need to make to inventory. All right. So in calculating the inventory balance for the group, we start with the amounts as reflected in the trial balances. So we will take 270,000 and we add 260,000. Okay, those are the inventory balances for the two companies respectively. And according to this journal entry, the elimination of unrealized profit in closing inventory, inventory for Green Limited, the parent, is credited. Okay, so in other words, this will be shown as a negative adjustment. And according to the information in the question, B represents the unrealized profit in closing inventory. So in other words, B represents the 62,308. Okay, the 62,308 has been replaced by B. Okay, so this will be one of the options given for the specific question. Okay, where B represents the unrealized profit in closing inventory. As you can see, A is nowhere in this calculation because according to our journal entry for that specific elimination, the inventory balance was not affected. Okay, so therefore it should not be taken into account when calculating the consolidated inventory balance. Okay, so this is how you will calculate the inventory balance for the group. You will add up the inventory balances for the two companies in the group, and then you will subtract the unrealized profit in closing inventory because this is in accordance with our journal entry. Okay, inventory for Green Limited has been credited So therefore it has been shown as a negative adjustment. And B represents that amount of 62,308. Very important that you pay attention to that calculation. Okay, let's move on to additional or question 6. The investment amount in the consolidated statement of financial position amounts to, the only investment line item that we have is the investment in Ryan Limited. Alright, as you should know, the investment in subsidiary from the group's perspective is a common item, which is eliminated at acquisition. Okay, as follows. It is part of the elimination of owner's equity of the subsidiary at acquisition. Okay, so in other words, the investment in Ryan Limited should not be disclosed in the consolidated statement of financial position. Okay, because from the group's perspective, it cannot have an investment in itself. Right, it's very important that you look at that from this perspective. So in other words, the amount of investment that will be shown in the consolidated statement of financial position, there is no other investments line item, so we assume that they are referring to investment in Ryan Limited. The amount disclosed in the group statement of financial position is 0. Why is it 0? Because that line item is eliminated at acquisition. Okay, let me show you how you will eliminate that specific line item. So in order to eliminate the owner's equity of the subsidiary at acquisition, we need to debit all the equity balances that were given at acquisition, right? And then we need to credit the investment in subsidiary line item as well as non-controlling interests, because we are dealing with a partly owned subsidiary. Okay, so as I've said, we will debit the equity balances. So we will debit share capital for Ryan Limited. We will debit retained earnings for Ryan Limited. Also revaluation surplus, because we had a revaluation surplus balance at acquisition. Then we have calculated goodwill as well. Okay, refer back to your analysis of owner's equity calculation. The amount of goodwill is 220,250. So we will also debit goodwill, and goodwill will be disclosed as a non-current asset in the consolidated statement of financial position. Okay, this will be addressed in the next question. So we will debit all of these items right here. So according to our analysis of owner's equity, share capital of the subsidiary was 1,550,000. Retained earnings 1,305,000. Revaluation surplus was 180,000, and goodwill has been calculated as 220,250, which is just the difference between the 2.8 million and 2,579,750. Okay, I will address this briefly in the next question. Okay, then we need to credit the investment in Ryan Limited, which is given in Green Limited's records as 2.8 million. Okay, refer to your debit section in the trial balances. And finally, we need to record the NCI balance, or the non-controlling interests, which we have calculated to be 455,250. Alright, this journal entry right here represents the elimination of owner's equity of Ryan Limited at acquisition. So through this journal entry, we can clearly see that the investment in Ryan Limited is eliminated. So therefore, the 2.8 million rand should not be disclosed in the consolidated statement of financial position. So the final answer for question 6 is nil, or simply put 0. Okay, why is it 0? Because it is eliminated at acquisition. So please make sure that you understand this journal entry and you are able to draft it correctly. Okay, just making sure that it balances. Right, let's move on to question 7. Goodwill in the consolidated statement of financial position amounts to, so we have already calculated this, in the analysis of owner's equity as 220,250. Now, this is a very popular question, okay, on the FAC2602 Telegram group that I have noticed over periods of time, or over time, ever since I have started to assist students with the module. I have noticed that a lot of you are struggling with the calculation of goodwill, or you do not understand how we arrive at that amount. So in your analysis of owner's equity, right, and I've also explained this earlier in the lesson, goodwill is calculated if there is an acquisition at a premium, okay, which basically means that the parent has paid more for its investment than it should have paid. Okay. In context of this scenario, Green Limited has paid 2.8 million rand for its investment in Rhine Limited. Alright. But the actual share that the parent has in the subsidiary's equity at acquisition is 2,579,750 rand. So because the total consideration exceeds the net asset value attributable to the parent, the excess amount is calculated as goodwill. So in other words, goodwill is calculated as the difference between the total consideration of 2.8 million and the net asset value attributable to the parent. Okay, the difference between these two should give you 220,250. Again, goodwill is 100% attributable to the parent, so no portion is allocated to NCI, meaning that the same amount will be shown in the total column. So the amount of goodwill, as disclosed in the consolidated summary of financial position, amounts to 220,250. 2,579,750. Please take note of this calculation so that you can understand how the goodwill is calculated. Alright, good. Let us proceed to additional information point, or not additional information, question 8, which asks you the correct journal entry to record the NCI share in Rhine Limited or the subsidiary in the current year, where the unrealized profit in opening inventory equals X and the unrealized profit in closing inventory equals Y, is as follows. Now, before we can complete this section, we first need to, before we can answer the question, we first need to complete our current year section in the analysis of owner's equity. So for the current year, profit for the year after adjustments, okay, and those adjustments will be explained now. Okay, so first we start with the profit after tax for the subsidiary, which has been given in additional information point 4. You can assume that the profit after tax for Rhine Limited amounts to 1,288,000 for the current financial year. So that amount will be entered right here, 1,288,000. Please take note that you can calculate this amount as well by adding up all the income items for Rhine Limited, so sales, other income, and interest income, and then you will subtract the expense items for Rhine Limited. So that will be cost of sales, income tax expense or taxation for the year. Okay, there has not been any interest paid, as well as other expenses. Alright, dividends paid is not an expense item because it does not meet the definition of an expense as set out in the conceptual framework for financial reporting. Okay, because dividends paid represents a distribution to shareholders or equity holders. Alright, then we need to go back to our elimination of unrealized profits in opening and closing inventory respectively. Okay, because the subsidiaries account or accounts are affected, we also need to show the relevant adjustments in the analysis of owner's equity calculation. For example, for the first journal entry where we eliminate the unrealized profit in opening inventory, okay, we have determined that we will debit retained earnings for Rhine Limited, and we have shown that in the since acquisition to the beginning of the current year section as a negative adjustment because retained earnings was debited. And the second component of this journal entry requires us to credit cost of sales also for the subsidiary. Right. So if the subsidiary's cost of sales is affected, okay, and it involves unrealized profit in opening or closing inventory, right? So the first place where you will show this elimination will be in the consolidated statement of profit or loss and other comprehensive income. You will take it into account when calculating the group's cost of sales. Okay, so you will decrease, or you will show this as a negative adjustment in that line item. Please refer to the suggested solution that I've posted on the Telegram group. I have explained it or shown the consolidated financial statements there. Okay, so this will be shown as a negative adjustment in the consolidated statement of profit or loss and other comprehensive income. But in addition, because it involves an unrealized profit, right, that has now become realized, and the subsidiary's cost of sales is affected, we need to show the adjustment in the analysis of owner's equity as well. Okay, so in your analysis of owner's equity calculation, current year, unrealized profit included in opening inventory. Now, since we are decreasing cost of sales for Ryan Limited, we are actually increasing their profit for the year, as I've also explained when we dealt with that question. So therefore, even though this will be shown as a negative adjustment in the consolidated statement of profit or loss and other comprehensive income in the cost of sales line item, in the analysis of owner's equity, we need to show this as a positive adjustment because we are adjusting the profit after tax as given, and because there is a decrease in cost of sales due to the elimination of the unrealized profit, this will be shown as an increase in profit after tax. So in other words, 73,846 will be added to the profit after tax according to our journal entry. So in conclusion, or in short, we will show this adjustment firstly in the cost of sales line item as a negative adjustment. That is in accordance with the journal entry, and because the subsidiary's cost of sales is affected, we need to show this in the analysis of owner's equity as well. In the current year section, we are decreasing cost of sales for Ryan Limited, and this will increase their profit after tax. So therefore it is shown as a positive adjustment right here. Right now we refer to the elimination of the unrealized profit in closing inventory. We have already dealt with the inventory component. Okay, I believe it was in question 5. Yeah, question 5, we have already addressed the inventory component. So in this journal entry, we are debiting cost of sales for Ryan Limited, and because it involves the elimination of an unrealized profit, we also need to show this adjustment in the analysis of owner's equity because the subsidiary's account is affected. Alright, so again, you will show this in the cost of sales line item as a positive adjustment because cost of sales is debited, so therefore the group's cost of sales will increase. Okay, please refer to the suggested solution. And in the analysis of owner's equity, we will need to show this as a negative adjustment. Why? Because we are decreasing the actual profit made by Ryan Limited in the current year, and we are doing so by increasing the cost of sales account. Or you can explain it the other way around. We are increasing cost of sales for the subsidiary, which in effect means that we are decreasing their profit after tax. Because an increase in cost of sales will decrease the gross profit, which will again decrease profit after tax, given that all the other amounts remain constant. So unrealized profit in closing inventory, again we will show this as a negative adjustment because cost of sales was increased. The reason why we show this in this section is because it involves the subsidiary's cost of sales. Right, cost of sales Ryan Limited has been debited. If cost of sales for the parent was debited, then that adjustment will not be shown in the analysis of owner's equity. Okay, please take note of that. Right, so The correct journal entry to record the NCI share in Ryan Limited, again, they have replaced the unrealized profit amounts by X and Y. Right, so how do you calculate the 194,931 using the two variables? We'll do that as follows. The NCI share in the current year's profit will be calculated as follows. We will take 15%, which is the percentage interest of NCI. We'll multiply this by, firstly, the profit after tax as given in additional information point 4. And then we adjust the profit after tax by taking the unrealized profit in inventory into account. So in other words, we will add the unrealized profit in opening inventory, which is represented by X, and then we will subtract the unrealized profit included in closing inventory, that is represented by Y. So simpler put, or easier stated, this is the formula that you will use to calculate the NCI share of 194,931. Okay, that was calculated based on this amount right here. The 1,299,538 was calculated as the sum of this section right here. 1,288,000. We then added the unrealized profit in opening inventory because that has increased the profit after tax due to a decrease in cost of sales. And then we subtract 62,308, which is the unrealized profit in closing inventory. Again, it is shown as a negative adjustment because we have increased cost of sales for Ryan Limited, and that will decrease the profit after tax. So you can confirm the correctness of this amount right here, or the formula here. Okay, this is the formula that you will use to calculate the NCI share in Ryan Limited for the current year. And there has not been any revaluation surplus in the current year that we need to take into account. We know that the subsidiary has paid dividends amounting to 65,000, but we have already addressed that in question 1. Okay, for question 8, they only want you to focus on this section right here. Right, so please make sure that you are able to take into account or bring in your variables in these questions. And then questions 9 and 10 have already been answered because they just ask you to provide the journal entries to eliminate the unrealized profit in opening and closing inventory respectively. So for opening inventory, okay, the journal entry was as follows. We will debit cost of sales for Ryan Limited. Let me just see if I can copy this right here. Damn it. Let's do it like this. So the journal entry that you will draft to eliminate the unrealized profit in the opening inventory, debit retained earnings for Ryan Limited, and credit cost of sales for the same company. And the amount is 73,846. We have already calculated that in additional information in question 3. Right, we have already drafted that journal entry. And then the journal entry to eliminate the unrealized profit in closing inventory will be as follows. We have debited cost of sales for Ryan Limited, and we have credited inventory for Green Limited. I have already explained both eliminations in detail, so please rewind so that you can understand how the journal entries have been drafted. And that, ladies and gentlemen, concludes today's lesson. As I've said, there were only 10 multiple choice questions in assessment 2 for semester 1. So I hope that this will assist you to a large extent in preparing for assessment 2 for semester 2, that at this stage should take place on the 12th of September 2023 at 6 p.m. Alright, please ensure that you work properly through learning units 1 to 7 right? You should have worked through 1 to 5 for assessment 1. So you need to ensure that you are prepared for assessment 2 by working properly through learning unit 6 and 7, especially learning unit 7. That is a very large learning unit with detailed principles that you will apply, especially in assessments 2 and 3. Right, assessment 3 will likely take the form of a formal exam paper. Okay, but we will focus on that when we get there. I would also like to thank you for supporting the YouTube